Hey, everybody. My name is Nicole Handy, co-owner of Braden Real Estate Group. And today we are doing something new for you guys. We are podcasting and we have our first guest today. But before we jump into the guest, I want to really set the stage for what's going on in Houston. Multifamily is exploding, guys. So today we're going to be talking about some new game changers in the Houston market for multifamily. I have our very first guest with us, Nebil Mathewos.
Hey, thank you for having me.
Nebil is with NRL Mortgage, guys. He is one of our preferred lender partners at Braden Real Estate Group. So I don't want to take up too much time. I'm excited about what's going on. I'm excited about what's changed in the Houston multifamily market. I think it's going to open up the floodgates for, people to become house hackers, people to start their investment portfolio. So I really just want to kind of jump right into it. So there's three main things, guys, that's changing. We are just going to break it down. I have the expert here,
Yes, ma'am.
Nebil, that's going to break it all down for us. But before we break it down, Nebil, tell us who you are. Tell us about yourself. How did you get into the lending industry and all of that good stuff?
Absolutely. My name is Nebil Mathewos. As you said, I'm a branch manager at NRL Mortgage. I've been in the lending space for 6 years now, but I've been in the financial services industry for 15 years. And I just have a passion for helping people become homeowners, for creating wealth through home ownership. It's just something I'm really passionate about. And I love doing it.
Cool. Well, I'm glad you're on. This is our inaugural podcast, right? So you are the very first guest. How do you feel to be the very first guest?
I'm honored and I'm nervous.
You're nervous?
Yeah, I'm nervous. I'm not a shy person, as you know, but I'm going to do my best.
All right.
Hopefully I don't disappoint.
Yeah. So, one thing we're really big on, like you said, is educating the people, right? And I feel like when you give, and you give wholeheartedly, it's reciprocated, right? So that's one of the reasons why we created this podcast. We created these segments because whether you're, a first-time home buyer, a seasoned investor, buying your third, fourth, fifth, or sixth home, you can always learn something, and so that's what I want to bring today. So like I said, guys, today we're going to be talking about what's changing, some of the game changers for multifamily in Houston. So let's first start off with the livable places ordinance, right? So Houston made a big announcement, and I know HAR, which is our Houston Association of Realtors, they were very involved with the city in pushing this change. So let's kind of talk about that because it's really opened up the floodgates as to how many doors somebody can even have on a single piece of property or a single lot.
Absolutely. So the Livable Spaces Committee for the past few years has been pushing for these changes, and their mission statement was to improve affordability, walkability, and equity in the Houston real estate space. So four main things that the Livable Spaces ordinance changes in regards to codes and regulations to building. One is the most interesting one we were talking about earlier is this new type of property, which is courtyard style housing, right? So, there's minimum requirements for lot sizes and things like that in Houston. With this new courtyard housing, they're going to allow for smaller units with no minimum square footage as long as there is a shared green space, which would be the courtyard. So imagine putting 3 or 4 smaller homes on a 5,000 square foot lot with kind of like a shared common area. That's going to allow for more units, more doors, which is one of their missions and goals. Another thing that they've done that's really cool is made it easier for homeowners to build additional units, ADUs, right, or garage style apartments. Those could be used for your children, mother-in-law suites, or rental units, right? And so that's going to help add some units and help with the housing.
So let's break that down really quickly. So now, if you kind of look at it, you can have like a main house and a separate living unit in the back, guest home, totally private space built on the same property. Right.
Absolutely.
So now I know a lot of people in the Airbnb space were like renting out rooms. So you had to have like possibly strangers coming into your home. You don't have to have that anymore with this ADU style.
With an ADU, it could be a garage apartment, as you mentioned, or a separate unit, and that's right. They'll have their own access, and so it can be a starter home for a young family member or Airbnb or something like that. Now, obviously, your deed restrictions take precedence over this, right? And so you got to make sure that the HOA allows for it, that it's allowable within your deed, but otherwise you could do that, and that's going to be a game changer.
So, in my opinion, that's house hacking.
For sure.
That's that's another form of house hacking.
For sure.
All right.
And that's one of the main objectives of the livable spaces. They want to increase home ownership, right? Houston historically is kind of more spread out with bigger lots, but now we're the fourth or third, maybe now, largest metropolitan city. And so there's a higher concentration of people and it's more dense.
So let's break that down even more. Let's just be transparent. Interest rates are high.
Yep.
Affordability has gone down. It has not gone up, it's gone down. So this, for what I'm hearing, is that it'll give people the opportunity to purchase more, to be able to just afford the homes at the price that they are now, but offset mortgage payments with rental units, ADUs, additional spaces they can rent out.
Absolutely. And that's one of the main objectives and mission statements for the Livable Places Ordinance, is to make homeownership more affordable. And one of the ways to do that is to make the cost of building these homes lower, right? And so if it costs the developers less, then they can sell the units for less and create more inventory.
So when people come to you and say, hey, I want to get approved, or they're looking, to look at their affordability, if they don't qualify for a particular amount, they can look at possibly getting ADU, house hack, something like that. Will you factor in their possible rental income?
Yeah, absolutely. So we can use on multi-units, which we'll talk about, you can use the proposed rent from the other units to help offset the mortgage payment.
Okay.
For sure, which is huge. So, we talked about the courtyards, the ADUs. One of the other things that they've done is lessen the requirements for minimum square footage of buildings. So now you could put smaller profile homes and did away with a driveway requirement. So historically, or currently, before these changes, you had to have 2 driveways for these units, right? Well, census show us that 40% of Houstonians either have one or no car. So if almost half of the people only have one car or no car, they really don't need 2 driveways, right? And that additional driveway cost a lot of money, right? Because they have to factor in drainage and things like that. So if you look at that additional driveway being 150 square feet, adding however many dollars to the deal, now that could be livable space, right? And it'll also reduce the cost of construction, which just benefits everybody.
So let me break that down in layman terms for the people. Okay. Basically, what he's saying is that before this new change, you had to have, like you said, a certain amount of driveway space for the cars. And honestly, essentially that costs the people that's building these properties more. So they have to sell them at a higher price. But if they can take that away, and that's not a necessity, that's not a requirement anymore, and they don't need to build out all of this driveway space, then essentially they can build for cheaper and in return sell to the consumer or the end buyer for cheaper.
Absolutely.
Okay.
Absolutely.
And what about our last one?
And then the last one is the one that we're most excited about, right, is the changes to the multi-unit space in Houston. So previously, you could only build a one or two, a duplex, essentially, right?
On a 5,000 square
foot. On a 5,000 square foot.
And when we say, for the people that's not in Houston, 5,000 square foot lot is like just the standard lot size for a single family home in the Houston area.
That's right. And a 3 to 4 unit home was considered commercial. So if you're a developer wanting to build a 3 to 4 unit home, you essentially have to abide by the same codes and regulations as someone who's building a 3-story 100 unit apartment, which is kind of ridiculous, right? And so now these changes make it a lot easier to build up to 4 units. In fact, they can now build 4 units in a neighborhood and up to 8 units like on a street.
Gotcha.
Right? So,
okay.
So that's gonna be huge.
So now people can take what used to only be allowed to be 2 doors, make it 4 doors.
Absolutely.
And we're going to go into, and that kind of really brings me into the next segment with Fannie Mae and their guidelines and what's just changed in terms of their down payment requirements for multifamily units. I was excited about it.
It's very exciting. And so the timing couldn't be any better. We have the livable spaces that we just talked about. And within a week or so of that, Fannie Mae announced that they made changes to their loan to value requirements on multi-units. And so that means...
What's loan to value?
Absolutely.
Just down payment, right?
Your down payment, right? So if you were buying a 4-unit home to house hack, right, which is buying a multi-unit, living in one and renting out the others, right? If you were doing that, you typically or historically want to use an FHA loan for that. That was the only play, right? Because FHA...
we'll tell the people why. Tell the people why historically that you only had to use an FHA loan in the past, or not only had to, but only wanted to for people that are house hackers. And let's break down house hacking real quick.
Absolutely.
House hacking is essentially offsetting your mortgage payment by buying more than one door and occupying at least one of the units. So let's start there.
House hacking is the most powerful way to accumulate real estate, to get in the game, right? You can purchase a 4-unit, 3-unit, or 2-unit home, live in one, rent out the other. Now, what makes that important is that as a primary, you can use a low down payment. If you're buying this as an investment property, you're gonna have to put a lot more down.
Yeah. So back before the Fannie Mae changed the guidelines, everybody went the FHA route because that was the lowest down payment option.
Absolutely. FHA, I could put 3.5% down, purchase a 4-unit property, live in it in 1 unit, rent out the other 2 or 3 units to help offset my mortgage. Yeah. And then if a year or 2 later, I decide to move or get another property, now I can convert that into an investment property.
Yeah, yeah. But let's talk about, let's have a transparent conversation, right? So I was excited to see the Fannie Mae guidelines change. So essentially, guys, what changed is, prior to them changing the guidelines, if you did not get an FHA loan and you got a conventional loan, you would be looking at a minimum down payment of 15% for a duplex, and it jumps up to 25% for a triplex or a quad. So Fannie Mae just changed the guidelines, and I'm gonna let the lender talk about it, but they just changed the guidelines to where now you can only, the down payment requirement, whether it's 2, 3, or 4 doors, to 5%, right?
Which is huge.
Which is huge, right? Huge. But there's a bigger piece, in my opinion, right? So FHA still does have a lower down payment requirement, but let's just be transparent. I've had to educate some of my developer clients that sell in multifamily properties on why FHA is okay. Just basically straight up saying, hey, I don't want to take an FHA buyer. And the reason why is because of all of the appraisal contingencies, and just being very transparent. The appraisal contingencies kind of make it hard sometimes for the developers to stand ground, with the sale of that property if it didn't appraise, right? So now it's opened the door for more people to not have to go the FHA route. But again, I've just straight up had people say, hey, I don't want to sell to an FHA buyer. We got to overcome that, number one.
For sure.
That's education. We got to overcome that. But now I want to talk about what are some of the advantages to going the conventional route now that they have offered the 5% down payment option.
Absolutely. But I want to speak to what you just talked about, because that's something that I'm very passionate about as well. We got to make sure that, the stigma with an FHA loan from a developer side is not adopted by the home buyers.
Right.
FHA loan is used by 70% of first-time home buyers for a reason.
100%.
It's the most powerful loan option for most people, right? And so developers tend to stay away from it for the reason that you just stated with the appraisal. But guess what? Those are buyer protections, right?
Right.
And so as a buyer, don't allow what they don't like about an FHA to impact the way you feel about an FHA loan. FHA loan is still the best loan option for most first-time homebuyers.
The best and the cheapest loan option.
Absolutely.
Too. The rates are lower, and the down payment requirement is extremely low. I think from a real estate perspective or a realtor's perspective, one, there is more paperwork involved. So what we started doing is, one, we started educating our developers on just essentially, hey, let's price right the first time, right? Let's avoid all the appraisal issues by just pricing right the first time, and then also too, here's the paperwork you need up front, right? So they're not scrambling for this on the back end when it's time to close. Just those 2 simple things has really changed our developers' mindsets on accepting FHA loans.
You hit the nail on the head, and that's why I love working with you. You have to understand why. What ends up happening is developers don't want to do it, or sellers don't want to do it for the reason that you explained, but then other people just hear FHA and they don't know why,
right?
And then they just say FHA bad, right? And so, and that's not the case. If you price the home accurately, right, and you do your comps, and you're confident that the home will appraise, and you're also confident that the home will pass the very minimum standards of an FHA loan, then there's no reason not to accept 100%. An FHA loan, right? I could have a conventional loan with a weak profile who's barely making it, or a strong FHA buyer. And what I tend to do in those situations is I ask my referral partners, hey, let's make the offer. provide me with the listing agent's contact information. And oftentimes I reach out and have a conversation and explain to them, hey, we could go conventional on this deal, but today, right now, FHA is a better loan product.
Right.
And so I'd hate to put my fiduciary responsibility is to the buyer, right? And so I want to make sure we're putting them in the best loan product that best suits their needs. And oftentimes for first-time home buyers, that is.
And then I want to say this also too, because I know FHA does have a lower loan limit, like how much they will lend you, opposed to a conventional loan.
Yep.
But I will say this, most of the duplexes, because they allow a larger loan limit for multifamily, fall within that loan limit with no problem.
For sure.
Yeah.
For sure. Where you get into, and then, that leads us into kind of what the difference is and the changes and why these changes are important. So, people will ask, well, why is it so exciting that you could go 5% on a multi-unit when you could always go 3.5%? 5% is more than 3.5%, right? So what are some of the changes and the differences of why you may want to go conventional as opposed to FHA? You touched on one of them already, is the higher loan limits, right? When you get into the 3 or 4 unit space, then sometimes the math doesn't math, right? If you get into a 4 unit, for example, that might be at a price point in some markets that is just outside of the FHA loan limits, right? Well, now with conventional, you could probably get that done. You can do a 4 unit, the conforming loan limit is going to be close to $1.4 million, right? With an FHA.
Stop. Let's say that again.
Okay.
So the conforming loan limit, basically, conforming means, for those that don't know what conforming means, that means that the conventional loan limit, right? The max that somebody can loan you for a 4 unit property is almost $1.4 million.
Nearly $1.4 million.
With 5% down. So that's basically saying you can get $1 million worth of property with only $50,000 down. And
that's what makes real estate so powerful, right? You could control $1 million asset with $50,000. If you were to buy $1 million worth of stock, you need $1 million, right? Crypto, whatever. But with real estate, you can leverage and control $1 million worth of property for $50,000. And that's huge.
Yeah, that is huge. So let's talk about what is required on the Fannie Mae side. So we know the down payment requirements, but I think a lot of people, when this change happened, everybody got happy, including me. I was like ecstatic, like, hey, here it is. This is the play. This is definitely how you house hack. But there are some back end requirements like the reserves. Sure. A lot of people missed out on talking about the reserve requirement as well. So you do need money, to purchase the property.
Absolutely.
Any property, you need money
for real estate.
Yeah, you need money for real estate.
Yeah.
There are, you hear people, including myself, talk about no down payment options, no closing cost options. Yes, those things still exist.
Right.
But in the grand scheme of things, you do need money to purchase real estate.
It's the exception, not the norm, right? In perfect scenarios, you could come to the table with a transaction with no money down. But for the most part, you do need money to purchase real estate.
So what about the reserve side? Because I think that's a lot, the biggest piece that people aren't talking about when they say, hey, you can now get a multifamily with only 5% down going the conventional route.
Yeah, absolutely. So one of the other changes, in addition to, you have to have the reserve requirement. In addition to that, one of the other differences between the conventional and the FHA when it comes to house hacking and why conventional may be a better option is the self-sufficiency test. That's a requirement for FHA loan. That's not for a conventional loan.
Now, what does that mean? Break that down.
So the self-sufficiency test, which is an FHA requirement on 3 and 4 unit properties, it simply means that the rent from the other units need to cover the mortgage, right?
Okay.
The total note. And so if that doesn't work out, then you won't pass the self-sufficiency test and you can't get that FHA loan approved.
Okay.
That requirement is not there with a conventional loan.
So regardless of what the rent rate is, you're more likely to get approved for a conventional loan opposed to, so just like for area, you're buying, let me give a scenario. You're buying a 4-door in a highly appreciating area, right? One that's growing through the roof. If you look at, the development that's coming in the area, is expect that the value of that area is expected to grow rapidly, but it just hasn't gotten there yet. It's on its way. You can look at, predictions and things like that and see that it's coming, but it hasn't gotten there yet, right? And I always say, get in before the change comes, because once you're in after the change, you're too late. You're paying the higher price, so get in before the change comes. So change hasn't come yet. It's in the pipeline. So rent rates are still low. And it may not cover the mortgage.
In that scenario, you're probably not going to pass the self-sufficiency test for
FHA. Okay.
Right? But then you can do a conventional loan as long as your debt to income ratio, which is the affordability calculation, allows for it, then you'll be able to do that. One of the other important pieces why you may want to go with this conventional deal over an FHA is that you also would not have to refinance if you want to rinse and repeat, right? So a lot of people talk about house hacking. You get an FHA loan, live in it a year, and then go do it again. Well, you can't just jump into another FHA loan in the same market, right? And even if you move 100 miles away, which is one of the requirements for having another FHA loan, you still need to show that you have 25% equity in that home, right? And if you just bought it a year ago, putting 3.5% down, you more than likely don't. So if you want to live in it a year and go buy another one, you either need to refinance or you need to use a conventional loan, right? And now that option is available.
So conventional will allow you to rinse and repeat, rinse and repeat, rinse and repeat.
Absolutely.
Without having to refinance or any other type of creative financing solution.
That's huge. And then another piece is if you factor in mortgage insurance. So if you have a stronger profile, like a good credit score, mortgage insurance premium on an FHA loan is a percentage of the loan amount, right? So whether you have a 600 credit score or 800 credit score, your mortgage insurance is the same.
Gotcha.
On a conventional loan, it's based on your profile. Private mortgage insurance is based on your profile. What's your credit score? How much you're putting down. So if you have a good profile, a good credit score, and you're putting a good amount down, then you will likely save a lot of money monthly. And that's going to help with your cash flow and help to offset that mortgage payment.
So I don't think we touched on the actual reserve requirement too. I know we saying you do need money to buy a home, right? But I don't think we actually touched on the reserve requirement for the Fannie Mae conventional loan. So talk about that, because I think that's important too, because I think that's a huge factor that people are missing, in terms of it's a game changer, because it's changed a lot of things in terms of the way people can get into these multifamilies. But let's talk about the reserve portion
so
as well.
The reason why reserve requirements are
and what does reserve mean for the people?
Reserve means additional funds or cash or assets that you have in addition to what you need to close.
So after you pay your down payment and your closing costs, this is the money that's required that you have in the bank set aside, right?
Absolutely. So you could, let's say your cash to close or your down payment and closing costs are $20,000, right? Well, if you have $20,100, you barely got enough gas money to get home from closing, right? And so if you have these additional units, what they want to ensure is that you do have a bit of reserves, a little more in the piggy bank, in the event that you have a loss of rent or something, you can make up.
What's the reserve requirement?
So typically on an investment property, the reserve requirement is 6 months of reserves for each unit. I don't know exactly what it is on the conventional multi-unit when you're house hacking. I believe it's either going to be 3 or 6 months.
Okay, so but just in layman's terms, so just say the mortgage payment is $2,000 for the entire property, right? And you need 6 months of reserves. That means you need $12,000 in the bank after your down payment and closing costs has been paid.
For each unit, yes.
Okay.
3 or 6 months of rent for each unit, whichever the reserve requirement ends up being.
No, okay. I mean, I'm excited about it still, because back in the day, I used to do tons of multifamily, tons of duplexes essentially. And, I always encourage my clients to go FHA because, let's just be frank, 25%, on a $1 million fourplex, you're looking at a ton of money to get in.
Absolutely. FHA was the only play. And, over the last couple of years, house hacking has become wildly popular. But Houston, our market, is not the best market for it. And this is going to help change that.
Why? It wasn't the best market in the past.
It was not the best market because we didn't have that product in abundance like they do in the Midwest or in the Northeast, where there are a ton of multi-units. Chicago is the multi-unit capital of the country, right? Per capita, they have more units available. You can get a 3-plex, 4-plex, no problem. Well, they stopped building those unit types here in Houston, like in the 40s and 50s. So that's why if you do see a 4-unit, it's typically 60 years old, 70 years old. And now they're reverting these changes with the livable places. That's going to incentivize builders to build these units.
And we're starting to see that. We're really starting to see that now. I know, and I talk about it all the time. I even have a list of, people you can get on my list to get access and first dibs to the duplexes houses that, me and my team have before they even hit the market, right? So it's becoming a popular thing. And let's just be frank, interest rates are a little high right now. So people are looking to offset their mortgage payment and things like that. So I'm saying this to say Houston is revved up building, multifamilies. And so in my opinion, from hey, I'm looking at house hack, now you can get a brand new one,
right?
That has low maintenance costs.
I want to add what makes your list so powerful now is that these units, as I mentioned, are super popular and there's not a whole lot of them. And so they go really fast, right?
Yeah.
And so if you're waiting for one to hit the MLS or hit the market, it's really hard to get one. But if you are on your list, then you can get access to those properties before everyone else in the general public gets to see them. So I think that's going to be a game changer for a lot of people.
Absolutely. So, I mean, guys, I think we've kind of touched on it all. We've touched on, hey, if you're looking to get in the investment realm, some changes now that can make your development costs much lower, and in addition, like I said, transpose that cost over to the consumer. Now you can sell your property for less, still make the same, you can still make the same profit off of it, but because you got in less or your cost was less, you can sell it for less. In addition, making it cheaper for the consumer. We told you guys about the new Fannie Mae guidelines for conventional loans. What used to be 25% down is now a thing of the past. You could get into a home with as little as 5%. And again, I have to say this again, and I have to say this again. And I'll be honest, Nebil is the first one that really made me put it in perspective like that for me. Is that, hey, you can get $1 million asset for only $50,000 up front. You can own $1 million asset for only $50,000 up front. I think that's huge. And in the mix of it, we kind of talked about all the FHA requirements. In my opinion, FHA is still a very affordable way to get into a multifamily as well. But now you got options. Now you have options, and people in the past didn't have options.
And that's what makes it so powerful and why it's so exciting. I know a lot of people are like, why are y'all so excited about this change? But in Houston, it's the combination of the livable spaces plus this change.
I think everybody wins.
If we didn't have the livable spaces and then the Fannie Mae made this change, that'd be great, but we don't have the product, right? And so now the timing of these two things, I think, are going to be, are going to change the landscape of the market. And it's at a perfect time because Houston is exploding, it's growing at a rapid pace. People are moving here from everywhere
because it's still affordable. Because it's still affordable. Like Houston is still affordable. It's still affordable. This is, in my opinion, some of the most affordable real estate in the nation. In terms of what you get. When we talk about price per square foot, the size for the price, it's very much so still affordable to live here.
Absolutely.
All right. Well, everybody, thank you. I want to thank you guys for joining and tuning in for us today. I'm Nicole Handy. This is, again, Mr. Nebil Mathewos with NRL. Tell the people where they can find you.
Yeah, absolutely. So you can follow me on Instagram. I'm Home Loan Hero. And I will have my contact information here at the bottom. I love working with first-time home buyers, move-up buyers. My passion truly is, helping people attain wealth through real estate. And so I love working with all my realtor referral partners, first-time home buyers. If you need any help, I'm happy to help.
All right. Thank you, Nebil. All right, guys. We'll see you guys on the next segment.